discounted cash flow model, or DCF. And to use a DCF, you can either calculate the free cash flow to the firm, or you can calculate the free cash flow to equity and input it into the model. If you are using FCFF in the DCF model, the output will be the firm value. And if you are using FCFE as an input to the DCF model, the output will be the equity value. So in this video,
teman-teman UI mungkin Pak. UI tadi belum teman-teman UI. Ya, Indonesia tadi belum kan Pak ya? Belum sempat. Nah ini makanya dari UI, apakah juga ada kendala terkait tentang backdropnya? Belum bisa. Belum bisa, Bu. Padahal sudah login dengan menggunakan akun universitas ya.
one of the most popular models in valuation is the discounted cash flow model, or DCF. And to use a DCF, you can either calculate the free cash flow to the firm, or you can calculate the free cash flow to equity and input it into the model. If you are using FCFF in the DCF model, the output will be the firm value. And if you are using FCFE as an input to the DCF model, the output will be the equity value. So in this video, we are going to look at how we calculate free cash flow to the firm, FCFF, and free cash flow to equity, FCFE, from financial statements. I'm going to use a hypothetical financial statement of a company for the year ended 31st December 2019. So we have the three financial statements, which is the income statement, the balance sheet, and the cash flow statement. The figures given here are in millions of dollars. We'll start with the income statement. The company has revenues of 5,000 million and operating costs of 4,000 million. And EBITDA, of course, is revenue minus operating costs, which is 1,000. Depreciation is 250, it's given. And your earnings before interest and tax is 750, okay, which is EBITDA minus depreciation. Interest expense is 200 million, so your EBT or earnings before taxes is 550. We assume that taxes is 40%, so that would be 40% times 550, so that would be 220. Your earnings before tax minus taxes, so you will get $330 million. And let's assume that dividend payments is 80 million, okay? Now, we move on to balance sheet. So we have the numbers for 2018 and 2019. We have the current assets comprising of cash and equivalents, accounts receivable, and inventory. And we have for non-current assets, there is only gross property, plant, and equipment. We minus accumulated depreciation, and we get the net PPE. And then we have total assets. Then for liabilities, we have current and non-current liabilities. Under current liabilities, there is accounts payable, notes payable, accrued taxes and expenses. And under non-current liabilities, I have long-term debt. And under equity, we have common stock, we have additional paid-in capital, and retained earnings. And lastly, just to check that the total asset is equals to total liabilities and shareholders' equity. Then for the statement of cash flows, okay, this is a reconciliation from net income to net cash flow from operations. And then there is a cash flow from investing activities and cash flow from financing activities. And then we will calculate the change in the cash and equivalents for the year. And then we'll add it to the cash at the beginning of the year, which is 390. So we'll get the ending cash and equivalents at the end of the year, which is 520. And then there are some supplemental cash flow disclosures here. So just to show a bit of reconciliation of the financial statements, what I'll do is I will try to show you how these numbers are linked up. So when we move on to the calculation of free cash flows, you'll be able to understand it better. Right, so net income, of course, is linked to, I'll just rebuild it again. So net income is from the income statement, of course. Depreciation is linked to the income statement, okay? Or we can actually take it from the balance sheet. If you have the accumulated depreciation, you could just take the difference, 1350 minus 1100. So of course you will get the negative form of it, but the amount in magnitude is the same. For accounts receivable, these are shown in the cash flow direction. So be careful when you calculate change in working capital. There is a way of doing it via the balance sheet. Okay, and when you interpret it from the cash flow statement, you have to be careful. So what I'm talking about here is, if you look at accounts receivable, the change here is from 630 to 690. So in other words, you are allowing your customers to owe money. Okay, so that means your money is stuck in this accounts receivable. If you take the change from the balance sheet, that will be 690 minus 630. So the change in accounts receivable is 60. Okay, from a balance sheet perspective. But from a cash flow perspective, there is an outflow there because you are using cash in this case. Okay, so when you talk about balance sheet changes, okay, a positive change in cash flow terms would be negative. Now, for inventories, again, inventory shows an increase of from 380 to 450. So if I take the balance sheet change, that will be 70. Okay, but on the in the cash flow statement, you will see a negative 70 because we bought inventories that will be a use of cash. For accounts payable, if I take the difference of 250 minus 230, I'm getting 20 here. In other words, you are delaying payment to the suppliers. You are owing the suppliers another $20 million. So that is a source of cash or cash inflow. And for accrued taxes and expenses, if I take the difference, 140 minus 100, again, when you increase the liabilities, okay, that will be a source of cash. And of course, so if you notice here that when the current asset increases, there will be a use of cash or cash outflow. And when the current liability increases, there is a source of cash or a positive cash flow. Now, if I sum up this, I will get a total of negative 70. In other words, your working capital is negative 70. Okay, there is a use of cash of $70 million there. So the total cash flow from operating activities is 510. So just to show you the sum. And the purchase of fixed assets here, okay, we call this the capital expenditure or capex. And it shows negative 500. Where do we find this figure? In the financial statement, in the balance sheet, you can take the difference in the gross PPE. So if I take the difference here, 3006 minus 3100, you get 500. Of course, when you buy more assets, there is a use of cash, so that is negative 500. Be careful with the difference between balance sheet items and cash flow statements. Now, of course, I can also try to obtain this using the net PPE. Okay, I could take the net PPE here, which is 2250 minus 2000, but don't forget, you will have to add in depreciation. So I will need to add depreciation in order to get 500. Okay, so be careful if you are reconciling from net PPE or whether you're calculating from gross PPE. Okay, you can still get the same number, but be careful that for net PPE, take the difference, but add in the depreciation for the year. And then for financing activities, they have issued short-term borrowings and long-term borrowings here. So that's why we get a positive number. If you see a negative number here, it means that the company repaid or redeemed or retired part of its debt. And we see that there is a payment of dividends of 80 million. So there's an outflow. So the total will be 120. So there's a net cash inflow there. And the total, if you take 510 plus 500, so if I take 510 plus negative 500 plus 120, so this is the change in cash and equivalents for the year. And we'll add it to the beginning cash at the start of 2019, so we'll get 520. Now we'll proceed to calculate the free cash flow to the firm and free cash flow to equity.
投资其实没有你想象中的这么难，最重要的东西就是说我们要懂得止损。不知道你有没有听说？
Now the first variation of the formula for free cash flow to the firm is to start from net income plus non-cash charges plus after-tax interest minus capital expenditure, capex, minus working capital investment. Let's start from this formula. So we'll start with the net income, which is 330 million. So that's equals to 330 million plus non-cash charges. Now, keep in mind that non-cash charges are things like depreciation. Okay, depreciation and amortization. It can be gain and loss on sale of assets. Okay, so these are the typical things that could be non-cash charges. But for this case, there's only depreciation, that's 250. And then we plus interest, which is 200 in this case, 200. And then multiply by 1 minus the tax rate. Tax rate is 40%, so that's 0.4. And then we have to minus capex and minus working capital investment. Now, what's the capex here? Capex in this case is 500. So we will minus 500. And then for working capital investment, you have to be a bit careful. For this formula, the working capital investment is based on the balance sheet changes. So there are a few ways how you can go about. If you are using the balance sheet changes, okay, in other words, I will calculate the working capital directly from the balance sheet, or we can use these numbers. I'll show you how the many ways of how you can do it, right? If you are basing it on the balance sheet changes, okay, what I'll do is, so I will create working capital, okay, and let's just call this. All right, so we have accounts receivable, we have inventory, we have accounts payable, and we have accrued taxes and expenses. All right, then I'll link to the numbers here. So the accounts receivable is 630, inventory is 380, accounts payable is 230, accrued taxes is 100. Okay, and then I'll copy this over. We get the same values. Now, working capital in this case will be the current assets, okay, minus current liability. So that's 680 for 2018. Okay, and then for 2019 that will be 750. So if you take the change here is 750 minus 680, that's 70. So when you substitute it into the formula, you will just write minus 70. So minus 70 here means it's an outflow. Okay, it's a use of cash because you increased your working capital. There is a use of cash. Now, if you're only given the cash flow statement, then what you will do is you will sum up, take the sum of the changes in working capital here. So negative 60 minus 70 plus 20 plus 40, that's negative 70. So immediately you can take the negative 70 here and replace it, okay, and replace it with this entire part. Okay, you will just change this to negative 70. Okay, so you could either use the balance sheet numbers or you can use the cash flow numbers. Just be careful and make sure you know how to interpret the numbers. All right, with that we'll calculate. So this will be equals to $130 million. To calculate free cash flow to equity, you can start by using the free cash flow to the firm, if you have it, minus the after-tax interest plus net borrowing. So from our previous calculation, free cash flow to the firm is $130 million. So we'll take 130 minus interest expense, which is 200, okay, from the income statement, multiply by 1 minus 0.4, which is 40%. And then now we need the net borrowing. So the net borrowing can be on the balance sheet changes. Using the free cash flow to the firm, if you have it, minus the after-tax interest plus net borrowing. So from our previous calculation, free cash flow to the firm is $130 million. So we'll take 130 minus interest expense, which is 200, okay, from the income statement, multiply by 1 minus 0.4, which is 40%. And then now we need the net borrowing. So the net borrowing can be obtained from two parts. Okay, if you are getting it from the cash flow statement, so we have notes payable, which is short-term debt, plus long-term debt issuances. So these are both inflows. So you will take 40 plus 160. So that will be 200. Okay, that's a positive 200 for net borrowing. It means the company is borrowing money. So there's a cash inflow. If you are using the balance sheet to get the numbers, be careful. Just look at the change in balance for notes payable. So 540 minus 500. Okay. So you just take the change, okay? And for long-term debt, that will be 1,007 minus 1,540. So that's what in total that's 200. Okay, so that's your net borrowing. So that will be, just to show, that's 40 plus 160, but it's 200. So if you take the numbers and add up, you will get $210 million. Okay, so that's your FCFE. Now we'll proceed to use other variations to compute the numbers. So FCFF can also be calculated by taking the cash flow from operations plus the after-tax interest minus capex. So what's my CFO in this case? So the CFO will be the net cash from operating activities, which is 510. So that's 510 plus interest expense 200 times 1 minus 40% minus capex, which is 500. So that will be equals to $130 million. Now, if you are starting from EBIT, or earnings before interest and tax, take note that you will have to take the EBIT after tax and then add in depreciation because it's a non-cash charges. Now, the EBIT here would be 750 million. So that's 750. Multiplied by 1 minus 40%, and then plus depreciation, which is 250, minus capex 500, minus working capital investment. Earlier we obtained the numbers as 70, so we minus 70. That will be equals to 130 million. The next variation is to start from EBITDA, okay, which is before interest, tax, depreciation, and amortization. The difference you have to be careful here is you will still take after-tax EBITDA, but for the next term, you will take the depreciation multiplied by tax rate. So this is the depreciation tax shield. So if I start from EBITDA, I will take 1,000, okay, 1,000 here, multiplied by 1 minus 40%, plus depreciation, which is 250 times 0.4 minus capex minus working capital investment. So that will be equals to $130 million as well. Now, there's another variation for FCFE, which if you're starting from net income, let's
I'm sorry, sir. You're mute.
Okay, sorry. So I said that so as you see so many questions in this video, and their purpose is that students know you have many ways to get estimation of free cash flows for equity holder or for the firm. Yeah. So Lilacs equation, the equation explain how we can use the income statement, net income, and at the back depreciation and the required term capital expenditure. So we know that every year the company have a additional investment, and this term is required. So we have to minus net. Okay, and we know the working capital, the changes. So as you see at in 18 in the 2018 year, and compared to the 2019 year, and as you see in the working capital items and items in the working capital, so payable and receivable inventory. Okay, so you see that accounts the receivable in for example accounts receivable that has the 630 and the incremental addition and into the 2019 that has the 690. So the the number is 60. Okay, so receivable, that means that this is the accrued item, right? So means the in future you have the right to get the number. Okay, but it not happen. Okay, so here you check that receivable item. So you have the 690 in the end of the 2019. Okay, so it's not happen, but you recognize. So you have to minus. Okay, minus this incremental the addition. Okay, so here, so in in contrast, the payable, see here, so the change over time from the 230 into the 250. So the incremental addition, the 20, right? But you just recognize the 250 and in 2019, but actually you don't need to pay it, right? The incremental addition. Okay, so here you plus back. Okay, so into your cash flows. Okay, so Alex, the WC Okay, so wait a moment. Sorry, erupt the call from the office. Okay, so here and we know the net borrowing, that means you issue securities to the public investors in stock markets or the bond markets. You collect the money from the investors, but the collect money, right? Okay, so if you clean over the time, you clean the old debt. Okay, so you issue the for example, you issue new debt, clean up the old debt. So for the cleaning the old debt, for your cash flows item, there is minus item. Okay, so here net borrowing means the issue debt, issue the stock, and minus the recurring the debt, old debt, and share purchase, yeah, or dividends, right? Something like that. Okay, so I just let you know. So here provide so many kinds of way they be used by manager or by the consultant, by the investors to evaluate the free cash flow to equity or to firm. Okay. So any question? So about my explanation to this question. Hello, anybody here?
Quite clear.
Okay. No questions. We get start. Okay, from here.
Let's say if you don't have the free cash flow to the firm, you can start from net income and then you will add in the non-cash charges like depreciation, minus capex, minus working capital investment. Just remember to add in net borrowing. So the only thing that is not here, if you compare this to the FCFF formula, is we don't add back the interest after tax. Because for the shareholders, it is after paying interest to the debt holders. So net income here is 330 million plus depreciation 250 minus capex 500 minus working capital investment 70, and net borrowing, as you have seen earlier, is 200, okay, which is 40 plus 160. Now if you calculate that, you will get a total of $210 million. Now you can calculate FCFE starting from EBIT as well, but just remember to take EBIT after tax plus depreciation, and remember to minus interest after tax. So just to show that it's reconciles, so EBIT is 750 times 1 minus 0.4 plus depreciation 250 minus interest expense 200 times 1 minus 0.4 minus capex 500 minus working capital investments 70, and then plus net borrowing 200. So if you calculate that, you will get $210 million. Okay, so it reconciles back to the formulas that we have used previously. So the next variation is based on EBITDA. So we'll take EBITDA after tax plus depreciation times the tax rate minus interest after tax. So EBITDA is 1,000. So that's 1,000 times 1 minus 0.4 plus depreciation 250 times 0.4 minus interest 200 after tax minus capex 500 minus working capital investment 70 plus 200 net borrowing. And if you calculate that, you will get $210 million as well. why are the numbers reconciling? Okay, if you compare these two, so if I take 750 times 1 minus 0.4 plus 250, so if I just compute this portion, okay, what you will get is 700. Okay, so that's what we are getting here. Now, if I do the same thing for this component, the EBIT after tax, the EBITDA after tax plus depreciation times the tax rate, what you will get is...
Okay, so if you use the EBITDA after tax, the EBITDA, so here, so plus the depreciation times the tax rate. Okay, so if you not use the EBITDA after tax, so you use the formula EBIT. So here, so EBIT the after tax the EBIT plus the depreciation. No need to multiply it by the tax rate. Okay, so compared to the equation to this equation. Okay, so here. Okay, so but the final destination is the same. Yeah, whatever you use the formula or that's the formula. So the final number is the 210. Okay.
The EBIT after tax, the EBITDA after tax plus depreciation times the tax rate, what you will get is also 700. Okay, so you will also get 700. So these two components are effectively equals to each other. Now, for the last variation, we'll start from the cash flow from operations. Okay, so cash flow from operations earlier is 510. So we start from 510 here minus.
Okay, so this is the formula arising from the consideration of the related activities. Okay, so here CFO, that means the cash flow operating. Okay, so we check and get the number from the here. So 150, 110. Okay, so then other the formula, then other the statement. Okay.
CapEx, which is 500, plus net borrowing 200, so that gives us $210 million. It's important to practice calculation as much as possible so that you get the hang of the formula. After a while, you'll be able to compute the free cash flows without much difficulty.
Okay, so so the cash flow so wait a moment. So why we needed to understand items in the cash flow equation. So because we have to get to know so where it come from, and we use the estimation methodology to estimate every terms in the formula. Okay, so to make sure our estimation is the correct. Yeah, so not a little bit larger the bias. Okay, so we allow the estimation a little bias, but we not hope our estimation is a little bit larger bias. Okay, because we have to deliver high quality report to our investors. There is our application to measure so the numbers in financial statements is very accurately. Okay, so in accurate numbers in financial reports we're not allowed, okay, to appear. Okay, so this every term in cash flow equation is very important, and how we calculate the every terms that's that's your requirements task. Okay, so next, right now we introduce the variation. Okay, so wait a moment. Okay, I think here, no, let me check. Wait a moment. Yeah. Okay, so the terminal value. Okay.
In these last few sessions, we've talked about how best to estimate discount rates, cash flows, and growth. In this session, I want to focus on a fundamental point that we all have to remember when we do valuation. All good things come to an end. What are those good things? If you have a high growth company, it can't keep growing at those rates forever. If you have a company with great products, those products might not stay great forever. In this session, I want to talk about closure in valuation, how we bring things together at the end. And you have two choices. At some point in time in your valuation, you can assume that your business will end and that you will liquidate it, sell it for what it can get on for the different assets. The other is you can assume that the business will continue beyond that point in time. It's called a going concern or a terminal value. That number creates more mischief in valuations than any other income. In this session, I hope to put some rules in place that will keep that number from running away from you. So we've talked about cash flows, we've talked about discount rates, we've talked about growth rates. We have one final piece in this puzzle that we've got to get in place for valuation to work. We have to put some closure on this process. What I mean by that is you can't estimate cash flows forever, right? The value of an asset is the present value of its expected cash flows over time. But what if you have an asset that potentially could last forever, as is the case with a publicly traded company? Since you cannot estimate cash flows forever, at some point in time you've got to stop. But you can't give up on cash flows either. And what most people do is estimate what's called a terminal value. So that's the role a terminal value plays. It's that number that you're using as a bookend to capture what will happen beyond year 5 or 10, or whichever year you put the terminal value in. So what I'd like to do actually is talk a little bit about the approaches used to estimate terminal value. And broadly speaking, there are 3 approaches that are used to estimate terminal value. In my view, one of these 3 approaches should never be used, but it's actually the predominant approach that ends up being used. Here's the first one.
The speaker mentioned the 3 approaches to do valuation. So what kind of 3 approaches, as you know? So the first approach is the intrinsic approach, intrinsic value approach. In other words, the cash flow model. Okay, you use the cash flow discounted by discount rate and summing up all the cash flows present values, and this kind of approach which is called intrinsic value approach. Okay, so the second approach is the relative approach. So relative approach, that means while you do valuation, you search for the relative benchmark. Maybe you search for example, you want to value one company's stock price. You can firstly you can find in the standard industry and the size the similar and you use the company this company the stock price to be your reference benchmark. Okay, so this kind of valuation, this kind of approach which is called relative approach or variation. And the last approach is the cost approach or the replacement approach. Okay, so replacement cost approach means if you want to value the company, you can try to sell it all in markets, and what's the value worth after you sell it. Okay, so that is your true value. Okay, so for example, you want to evaluate a chair used and you sell it online, and okay, so the one buyer buy it 100. Okay, so it so over the time the chair price, the chair is worth the 100. Okay, so this kind of this is kind of approach which is called a cost approach or replacement approach. Okay, so the basically there are three approaches in business valuation and asset pricing. Okay.
At the end of year 5, year 10, year 15, you can shut the business down and sell off its assets. That's called liquidation value. When I value private
So
business,
here, kind of the similar concept to the valuation. So here, our target is terminal value. So we use liquidation. Okay, liquidation like you sell the asset in the public markets. What's the value worth? Okay, to buyer. So liquidation value. And the second approach, like I said, there is a relative approach. The last approach that is similar, quite similar to the cash flow model, okay, or the intrinsic value model, okay. So it applied the three approaches in varying assets and to the terminal value. Okay, so here also the provide the three kinds of approaches to value the terminal value. Okay.
that is pretty much how I estimate terminal value almost all of the time. Because when the owner ends a business, that's pretty much what happens to business. It gets sold off in pieces. The second alternative is to assume a going concern value, which is to assume your company will keep going after year 5 or 10, but that its cash flows will grow at a constant rate forever. You're saying, what will that do for me? If your cash flows grow at a constant rate forever, you have what's called a growing perpetuity. Again, you might wonder, so what? If you have a growing perpetuity, you have an infinite series. Now, this is becoming a mystery. An infinite series in mathematics, we know the answer to. We can actually solve the value of an infinite series. That's pretty much what happens when you have a growing perpetuity. You can write an equation that captures the present value of all cash flows beyond that point in time if you're willing to assume that your cash flows will grow at a constant rate forever. That's a going concern value. Liquidation value and going concern value are both legitimate ways to get a terminal value. So I've given away the game. Here's the one way you should never use to get a terminal value. You shouldn't apply a multiple to year 5 or year 10. So I've given away the game value.
Here going concern value and the liquidation value. So yeah, so you either use the going concern value or the liquidation value. Okay, so liquidation value, that means you stop the operation over the time, And going concern value, that means you continue to operate. Okay, but whenever you use the liquidation value or going concern value, actually the same, I think. Yeah. Okay.
Liquidation value and going concern value are both legitimate ways to get a terminal value. So I've given away the game. Here's the one way you should never use to get a terminal value. You shouldn't apply a multiple to year 5 or year 10 numbers, an EBITDA multiple or a revenue multiple or an earnings multiple. What's wrong with it? If you do that, you're really not doing intrinsic valuation. You're doing relative valuation. You're using a multiple. Your multiple is way out in the future, but it's still a multiple. People who use relative valuation to get their terminal value and claim to have done a discounted cash flow valuation are really presenting a relative valuation in what I call drag. Those cash flows in years 1, 2, 3, 4, and 5 are distracting. They're distracting because they're distracting you from the key number used in the valuation, which is the 8 times EBITDA used to get a terminal value. So the next time you see a discounted cash flow valuation, check out the terminal value. If it comes from a multiple, call it what it is. It's a forward relative valuation. So your choices are liquidation value or going concern value. So the standard approach to estimating terminal value is that going concern approach, where you assume your cash flows grow at a constant rate forever. That's a very convenient way to estimate terminal value, but it can also get you into trouble. In fact, when you look at valuations, the number that usually gets valuations in trouble is the terminal value number. So I'm going to introduce 4 very simple rules to keep your terminal value in check, to keep it from running away with your valuation. First check. Make sure that you don't exceed the cap. What am I talking about? Remember, in a going concern, terminal valuation, you assume your cash flows will grow at a constant rate forever. That growth rate, we said, cannot exceed the growth rate of the economy. But that leaves you with an estimation problem. You don't know what that growth rate is going to be. So here's a proxy you can use for the growth rate in the economy and as a cap on your terminal growth rate. Use the risk-free rate. Think about what goes into risk-free rate.
You can
Inflation,
focus mainly
expected
on
real interest
this
rate. Think
this
about what
part.
goes into the growth rate of the economy, expected inflation, and an expected real growth rate. I think the risk-free rate is an excellent proxy for the nominal growth rate in the economy. But even if you don't think it's a good proxy, I still think it makes sense to use it as your cap on your growth rate. And here's why. If you think the risk-free rate is too low, your cost of capital is too low, right? To compensate then, I'm going to force you to keep your growth rate low. It keeps your valuations in sync. So use the risk-free rate as the cap.
Okay. So I think we can use the KPM. KPM, we know the risk-free rate plus risk premium. Okay, risk premium determined by the beta um, and the assets market return. Assets market return calculated by market return minus risk-free rate. Please take a note.
Cap on your growth rate. That's the first rule. Here's the second one. You have to make a judgment about when your company will become a stable growth company. My advice, don't wait too long. I've seen discounted cash flow valuations where people wait 20, 25, 30 years to put their company to stable growth. That's extraordinarily long. And here's why. If you look across the history of the US market and you look at growth companies, about 99% of growth companies have growth periods less than 10 years. In fact, the median growth period for a high growth company is about 3 to 5 years. I never use more than 10 years as a growth period in my discounted cash flow valuation. And if you're looking across companies trying to decide which company should grow for longer and which shouldn't grow for 5, maybe 6, 8, 10 years, here are some of the things you should look at. One is look at the size of your company relative to the market that it serves. If you have a large company in a mature market, Toyota for example, don't get carried away. Where's the growth going to come from? Use a shorter growth period. If you have a small company in a huge market, Whole Foods and groceries for instance, you have much more leeway. You can allow for a longer growth period. Second, look at recent growth, not in earnings, but in revenues. Revenue growth rates give away the game before earnings growth rates catch on. So if your revenue growth rate last year was only 5%, be wary about using long growth periods and high revenue growth rates. And third, remember, it's not growth that creates value, it's growth with excess returns. The stronger and more sustainable the competitive advantages your company has, the longer its growth period can be. So do some strategic analysis of your company. Third step in the process, think about excess returns. What am I talking about? I'm talking about the return on capital you think your company will earn in perpetuity. Remember, that return on capital is going to come under downward pressure from competition. So one of the issues you have to examine in terminal value is what kind of return on capital you're going to give your company, and it's a big decision. And here's the number you should compare it to. You should compare it to your cost of capital and stable growth. If you assume, as some analysts do, that in steady state, stable growth, you cannot maintain competitive advantages, then the logical assumption is the return on capital should go to the cost of capital. The excess return should go to zero. If that is the case, it doesn't matter what your growth rate is. Your terminal value will be the same whether you 0% growth, 1% growth, or 2% growth forever. If you set your return on capital above your cost of capital, and you might do that for some companies with really long-term competitive advantages, then your growth rate will still matter, but not as much as it would have if you hadn't brought the return on capital down. My rule of thumb with return on capital and stable growth is for 80% of companies, I go to the default. The default is, as I said, it equal to the cost of capital. For 1 in 5 companies, where I think that the competitive advantages are large and significant, I will leave the return on capital above the cost of capital by maybe 2 or 3%. That gives these companies an advantage and a higher value. Last piece, when you make your company a stable growth company, give it the characteristics of a stable growth company. In other words, if you have a beta of 2 and a high cost of capital during your high growth phase, that's okay. But when your company becomes a stable growth company, I would expect to see the beta move towards 1, maybe see it use more debt in its capital, and a lower cost of capital. Your company cannot change in terms of growth with everything else remaining intact. So in summary, when you look at your terminal value, make sure your growth rate is capped. Make sure you're putting your company into growth at a reasonable point in time. Make sure you're thinking about excess returns in perpetuity, and make sure that you're giving the company the characteristics of a stable growth company. If you do that, your terminal value will stay within your control.
Okay, so I mentioned so the first one, the liquidation. Liquidation. Also, maybe sometimes use the replacement. Okay. Cost. Okay. So second, relative. So that's one. Intrinsic. Intrinsic value. Okay, so I use this one to explain. Okay. So we know CF1 cash flow received at day 1. CF2 receive the cash flow at day 2. CF3. Okay. Okay. So a series of cash flows you receive, right? And we know here discount discount used R. R is your discount rate plus, okay, the plus the discount, 1 plus discount rate square. So here, discount rate here, okay. Okay, this, okay, so this is a series, okay, series of present value, right? Okay. Present values. Okay. This one, this block, which is said to be, going, okay, going concern value. Okay. Concern value. Okay. If your option is not going to continue your operation, so you stop right here. So in other words, you can call this block is the terminal value. Okay, terminal value. Alternatively, terminal value. Okay. So if you call this the terminal value, that doesn't mean you stop the operation at the desk 3. Okay. Okay. So before that, you also have the three cash flows, right? Okay, this one. Okay. And here are how to estimate R by model. So you can use the CAPM, WACC, ICAPM, IAPM, okay, CCAPM. Okay. Okay, so step price, state price. Okay, contingent claim. Okay, so are many kinds of models to be used to determine the R. Okay, so CAPM, the full name is the capital asset pricing model. The WACC is the weighted average cost of capital. ICAPM is the intertemporal capital asset pricing model. IAPM that is the international asset pricing model. CCAPM is consumption capital asset pricing model. Step price. Okay, so step price. So we know this is the either 1 and 0 or the 0 1. Okay, that's your pure security. After using that to price the anything. Okay, so here this is the basic framework. So you have built this kinds of concepts into your mind. Yeah. Okay, so any question?
No, sir.
Okay. Yeah. So okay. So next. So let us watch the value enhance. Okay. So value enhance is the important is that. Okay. So for example, here CF1. I just use the one period. 1 plus R. Okay, is CF0. Okay. How we enhance the CF0? So first, okay, increase the CF1, right? Okay, increase and decrease the R, right? Or uh, give more cash flow future. Okay, CF2, CF3. Okay, okay. So this. So CF2, CF3. Okay. Okay, this kind which are the enhancement value. Okay. Okay, let us watch the video.